So, you've just dived headfirst into the world of investing. You're positive, hyped, and ready to take on the world. But let's face it, investing isn't always a smooth ride. There are hidden obstacles that can derail even the most enthusiastic beginners. You were watching Prosperity Pulse Point, and today we're going to expose the weird, often overlooked reasons why new investors end up throwing in the towel. I'm talking about the psychological traps that can sabotage your financial journey. But don't worry, I'm not just here to point out problems. I'm going to give you actionable strategies to overcome these challenges and stay on track. And as a bonus, I'll share a proven investment mindset hack that can supercharge your returns. So make sure to watch till the end. Chapter 1: FOMO. Let's talk about FOMO, or fear of missing out. It's that nagging feeling that everyone else is making a killing in the market except you. You see those screenshots of huge gains on social media, and it starts to feel like you're missing out on the next big thing. FOMO can be a powerful force. It can push you to make impulsive decisions, like buying a stock just because it's trending without doing proper research. Remember, not every investment is a winner. Chasing quick profits can lead to significant losses. It's important to focus on your own investment goals and time horizon. Just because someone else is making money doesn't mean you need to replicate their strategy. Every investor's journey is unique. Chapter 2: Confirmation Bias. Confirmation bias is like putting on rose-colored glasses when it comes to your investments. It's the tendency to seek out information that confirms your existing beliefs, while ignoring evidence that contradicts them. For instance, if you've invested in a particular stock, you might spend hours searching for news articles that support your decision to buy, while completely ignoring negative reports. This can be dangerous. By only focusing on positive information, you might miss crucial red flags that could signal a potential downturn. It's like being stuck in an echo chamber, surrounded by opinions that reinforce your own. To combat confirmation bias, actively seek out different perspectives. Read articles and watch videos from analysts with opposing viewpoints. Challenge your assumptions and be open to changing your mind based on new information. Chapter 3: Revenge Trading. Revenge trading is like trying to win back lost money by gambling more. It's an emotional reaction to a loss, where you let anger or disappointment drive your investment decisions. For example, if you sell a stock at a loss, you might be tempted to immediately buy it back at a higher price just to prove yourself right. Or you might invest more money in a different stock to recoup your losses quickly. I've been there. After a particularly painful loss, I found myself pouring more money into a speculative stock, hoping for a quick turnaround. It was a classic case of revenge trading, and it didn't end well. The key to avoiding revenge trading is emotional control. Take a step back and let your emotions cool down before making any impulsive decisions. The thing is that the market doesn't care about your feelings. Focus on making rational decisions based on facts and your long-term investment goals. Chapter 4: Lifestyle Inflation Creep. Lifestyle inflation creep is that sneaky habit of increasing your spending as your income grows. It's like a slow-moving train that can derail your financial goals. You get a raise, so you buy a new car. You get a bonus, so you book that expensive vacation. Before you know it, your savings account is looking a bit bare. I have a friend who got a promotion and decided to upgrade his entire wardrobe, move to a more expensive apartment, and buy a new car. While these things are nice, they also ate into his savings and slowed down his investment growth. It's essential to create a budget and stick to it, even when your income increases. Automate your savings to ensure that a portion of each paycheck goes directly into your investment account. Remember, it's not about how much you earn, but how much you keep. Chapter 5: Social Pressure to Conform. Social media is a double-edged sword for investors. On one hand, it can be a valuable source of information. On the other, it can create immense pressure to conform. You see your friends and followers investing in a particular stock or cryptocurrency, and you start to question your own decisions. The fear of missing out on potential gains can be overwhelming. It's important to remember that everyone's financial situation is different. Just because your friend is making money on a specific investment doesn't mean it's the right choice for you. Investing based on someone else's advice without doing your own research is a recipe for disaster. Focus on building your own investment knowledge and creating a diversified portfolio that aligns with your goals. Don't let social media dictate your financial future. Chapter 6: Fear of Success. It might sound counterintuitive, but many people are actually afraid of success. When it comes to investing, this fear can manifest in various ways. For example, some investors might sabotage their own success by taking unnecessary risks or selling investments too early. Others might become overly cautious, missing out on profitable opportunities. Fear of success can also lead to procrastination. You might keep putting off making important investment decisions because you're afraid of making a mistake or failing. It's a strange psychological phenomenon, but it's more common than you might think. Chapter 7: Superstitions and Beliefs. Investing can sometimes feel like a mix of science and superstition. Many people hold on to irrational beliefs and superstitions when it comes to money. Things like lucky numbers, avoiding making decisions on certain days, or believing in market cycles based on astrology can influence investment decisions. While it's harmless to have personal beliefs, it's important to base your investment journeys on facts and data, not on luck or intuition. Chapter 8: Overcoming these obstacles. Conquering the psychological challenges that often derail new investors requires a multifaceted approach. At the core of it lies a well-structured investment plan. This blueprint should outline your long-term financial goals, your risk tolerance, and a diversified investment strategy. A clear roadmap lessens the allure of impulsive decisions, often driven by emotional spikes. Emotional intelligence is your secret weapon in this journey. Understanding and managing your emotions, especially during market volatility, is paramount. Techniques like mindfulness, meditation, or deep breathing can be invaluable tools to maintain composure. Remember, fear and greed are common adversaries. Your ability to navigate these emotions will significantly impact your investment outcomes. Surrounding yourself with a supportive investment community can be a game changer. Sharing experiences, learning from others, and receiving encouragement can bolster your confidence. A strong support network can offer a different perspective, helping you avoid common pitfalls. There's no shame in seeking professional advice. A financial advisor can provide expert guidance, helping you navigate complex market conditions and make informed decisions. Remember, their role is to complement your investment journey, not replace your involvement. By consistently focusing on your long-term goals, managing your emotions effectively, and seeking support when needed, you'll build a solid foundation on your financial future. Chapter 9: Investment Mindset. Now, I promised you a secret weapon to supercharge your investment returns. It's a mindset, not a magic formula. I'm talking about the approach of legendary investor Warren Buffett: long-term investing. Think of your investments as seeds you plant in fertile ground. You don't expect a tree to grow overnight, do you? The same goes for your money. The beauty of long-term investing is that it immunizes you against the psychological traps we've discussed. FOMO, confirmation bias, and revenge trading are short-term emotions. They thrive in the noise of daily market fluctuations, but with a long-term perspective, these distractions fade into significance. You're not chasing quick wins, you're cultivating a financial forest. Lifestyle inflation and social pressure lose their grip when you focus on the big picture. You're less likely to splurge on unnecessary expenses if you're building towards a substantial future. And peer pressure fades when you realize that everyone's financial journey is unique. Fear of success and superstition dissolve when replaced by the confidence of a well-thought-out, long-term plan. You're not gambling. You're making calculated bets on the future. Embracing a long-term mindset doesn't mean ignoring market trends or avoiding opportunities. It means approaching investments with patience, discipline, and a focus on underlying value. It's about owning a piece of something great and letting time work its magic. By shifting your focus from short-term gains to long-term growth, you'll not only protect yourself from common pitfalls, but also set yourself up for extraordinary financial success. So that's all for today. If you found this video helpful, don't forget to hit that like button and subscribe for more investment insights. Let's build a community of smart, savvy investors together. Thanks for watching.